Well, reporting season has been and gone, and it was eventful. I copped a couple of bad reports directly on the chin, and it left a mark. But we somehow still made money since the last episode. Add to that a minor recalculation of last episode's gains, because there was a dividend that my script didn't pick up. All the other companies had the company name in the dividend message, but for some reason Tamerwood's dividend was just random numbers and letters. Whatever, bro. Anyway, like I said, we caught a couple bad reports and it hurt. But it taught me some important lessons. And the thing about the lessons that you learn on the stock market is that sometimes they are more expensive not to learn. I think making these videos has been really valuable for me because it forces me to stop and reflect on all the bad decisions I made in the period as I write about them. Of course, it lets me reflect on the good decisions too, but that's not really so important. If all I wanted was to blow smoke up my ass, I could buy a fog machine. The bad decisions are the ones that are important to reflect on, because those are the ones you need to avoid making again. But before we get into the gritty details, let's take it from the top, chronologically. Before any reports even came out, I made one trade. I reduced my holdings of Hum, because it rocketed up to around 70 cents, which, as I said in my last video, was my tentative price target. I pulled the trigger a little bit earlier than I said I would, and sold 1/3 of my holdings at 65 cents. Pocketing a 50% capital gain. Hindsight has revealed this to be the right move, as when the earnings came out the month after, which weren't even that bad, the share price shot right back down to exactly where it was last episode. So I was sitting on a tiny bit of cash from that sale going into reporting season, which ended up coming in handy. Then the reports started coming out thick and fast. The first company in my portfolio to report was Tamerwood. But nobody gave a shit, because they already released unaudited results last month, and even those were pretty much as expected anyway, so the share price didn't move at all. Then the next company to report was ORA. ORA was one of my most anticipated financials of the season, because it would be the first opportunity to look inside the new Saberglass acquisition. I thought the Saberglass acquisition was sound, and I was really focused on the contributions that would make to the company. But the problem was, I wasn't really thinking very much about ORA's original business going into the report. I was expecting some mostly boring results that would track with previous years, followed by the share price not doing very much at all. My mind was already racing ahead to July when the next financial year starts, deciding what to buy and what to sell, looking for new tickers to replace the old ones, etc. But when ORA released a 9% decline in revenue, I realized that I'd kind of fucked up. The results weren't even that bad. That's not the point. Profit was flat, the acquisition went smoothly, the Australian segment grew. It's still a good company that I want to own. But the point is, good company or not, I want to say lazy, but it wasn't laziness. I was working hard on the wrong thing. I was working hard at trying to find the next company I could buy. But I felt arrogantly safe in my stock picks and didn't feel much need to monitor the economic conditions that affect ORA, and that was a big mistake. The signs of this revenue decline had been publicly available on the internet for the past 6 months, and I just never bothered to look it up. The drop in revenue was entirely driven by a reduction in volumes in the US. The US manufacturing PMI, which is used as a leading indicator of growth or decline in US manufacturing, has been in contraction every month of the reporting period, and I just never bothered to check it. If I had, some quick napkin math would have told me to expect an 8-ish% decline in US revenues. So why, with earnings about to come out, did I not do some final due diligence in the lead up to make sure the results would be good? Well, I guess I was a little arrogant. I have done very well this financial year, but that's not the main reason. The biggest reason is, I think, I'm overcompensating for my old habit. For many long years, my fatal flaw as an investor was that I would smash the sell button anytime I saw the color green, and it meant I was always destined to miss out on life-changing gains. I have worked hard to kick this habit, and it has been worth it. The thesis is simple. I've got a good track record on stock picking, and a bad track record on trading, so I should do as much stock picking as possible and as little trading as possible. But I think for the first time in my entire life, I have the opposite problem. I am now under trading. I didn't look up the US manufacturing PMI data ahead of the ORA report because what was I going to do? Sell? That would be trading, and I'm bad at trading, so I shouldn't do it. But when ORA lost 8% of its value in a day on my watch due to a revenue miss that I could have easily seen coming, it gave me a moment of clarity. My fear of overtrading had become irrational. If I can see a miss coming, shouldn't I just step out of the way and buy it back a few days later? I immediately put this lesson to work by selling the rest of my BRI holding. I said in the last episode that as much as I like the company, I was expecting a bad report, and that's exactly what we got, with profit falling 50% over PCP. The share price fell by 8.5% over the 3 days after I sold, meaning that my lesson about undertrading was already paying off big time. Because unlike the ORA drop, this time I managed to get out the way. Now I am well positioned to buy back into BRI on the cheap, and I definitely will, as I still think it's a great company that's well positioned to benefit from any rate cuts that may appear over the next year or two. However, I'm sure the negative sentiment from this report will stick around for at least a few weeks, so I'm not in a rush to get back in, and there's even a possibility that I'll hold off buying back in until the start of the new financial year in July, when I liquidate my winners. Then there was the Hum report, which I mentioned earlier. I have said pretty much ever since the start of this series that I am not sure Hum has their shit together. I have been perpetually suspicious of them due to their habit of constantly posting losses backed by big normalized profits, where they take out a bunch of things that are supposed to be one-offs, and then they say, hey look, if you ignore all that other stuff, we made a profit. But then they're not really one-offs, because they do that every fucking report. See look, here's the one they posted this time. At the bottom, you see a statutory loss of $6 million for the period. Not so crash hot, right? But then they go, oh, a lot of these things shouldn't really count though. Like intangibles are just made up, right? So we take them out. And yeah, fair enough, intangibles are bullshit, so you get 5.5 million back from that, which brings them to a loss of $500,000. And then they go, oh, well actually, another 8.4 million of that is just because of an accounting provision where we have to anticipate losses that we're expecting to take if people don't repay their loans. We created a bunch of extra loans, so we have to write off some of them, but they haven't actually failed to repay their loans yet, so that shouldn't count, right? And then I go, wait a minute. Some of those loans will go bad though, and this seems like a very reasonable way to account for that ahead of time. Should you really be subtracting that? And then they go, well, by the time they go bad, we'll have accrued interest on the other 98% that haven't gone bad. Because we only just made these loans, we haven't had any chance to profit on them. So it's a bit unfair to recognize the losses ahead of time without also recognizing the profits ahead of time, right? To which I say, okay, I guess that's fine. What's the next? Depreciation? Are you fucking kidding me? Taking out depreciation is not normalizing anything. Depreciation is already extremely normal. It's how you write off the value of capital expenditures over time. Did you mark it as a loss when it was capex? No. Then you need to mark it as a loss when it depreciates. You can't have it both ways, because if you did, then capex would just never get subtracted from profits. You could profit your way to bankruptcy, which is not how this works. That's not how any of this works. Anyway, I think you get the picture by now. Some of the normalizing is very reasonable. Some of it is a grey area, and some of it is downright depraved. This is why Hum has exclusive rights to the naughty corner in my portfolio. But all up, once you've gone through all the numbers, the report didn't look all that bad, and I'm comfortable continuing to hold a small amount into next year. Then the CRN report came out, and CRN tanked, which is honestly super confusing because all of the bad news had already been announced to the market in October, and it should have been priced in, so I'm not sure what the market was surprised by. I can only assume it was the high production costs, or maybe the forward pricing guidance, which wasn't that great. But for the first time since the creation of the new portfolio, a stock fell far enough from my initial buy price that I decided to double down. So I've increased my CRN holding to 18,000, which is pretty much my standard holding size. It was a little small before. This has brought my average down to about 152, which I think this company can easily rise above and beyond on the off chance they can make it 3 months without breaking something expensive. Oh yeah, by the way, the charting script I wrote struggles when you combine realized gains and unrealized losses on the same company. On a real chart, the bar should be shorter and I'm too lazy to fix it, so I've just used MS Paint to make it obvious that the red part is a descending bar and the actual top of the bar is at the bottom of the red part, i.e. CRN is looking at about $1,000 of gains this financial year. But not everything was doom and gloom this reporting season. There were also a couple of bright spots. During the reporting period, we racked up a 30% gain on BFL, which kind of came out of nowhere, especially since the news coming out of P&G this year hasn't been the best. But it just goes to show that good companies win out in the long run. I'm not worried at all about the longevity of the BFL gains and plan to hold them all the way into next financial year and possibly even beyond into 2025. The earnings yield is good, but mostly there's just something calming about having a bank in the portfolio. They're just so goddamn boring that it's like an antidote to the white-knuckle anxiety-inducing bullshit that the rest of my portfolio is prone to pull at this time of year. Did you know that at one point I was down $10,000 in 3 days? Hum, ORA, and CAA all took a shit simultaneously. I was like, oh god, I'm a fraud. I just lost 5% of my portfolio in 3 days and now I've got to upload it to YouTube so the internet can laugh at me. Fortunately, however, Hum and ORA were already up so much that month that the big losses were essentially just resetting them to where they were a month ago. And CAA came back up because why wouldn't it? It's a god tier stock that's been carrying my portfolio all year. It's not going to stop now. The other bright spot was SRG, which increased profits by 30% and raised its EBITDA forecast for the year. The share price didn't do a whole lot on the back of this report, so I immediately bought another parcel. I was up 10% on SRG before I averaged up, and I hate averaging up. But for a company doing numbers like this, there's no reason that it should be any less than 10% of my portfolio. The latest purchase brings my holding up to $21,000, or a little over 11%. Then there was the CAA report. In the lead up to the report, Capral came down a long way from the all-time highs it reached last episode. But their numbers were absolutely monstrous once again, never failing to remind me why it's my largest holding. I love this company. When it came off the highs, I considered buying more, but it's already my largest holding by far. I want to stay diversified, and I hate averaging up on stocks. I'm up 30% on Capral right now, not including dividends, so it doesn't take me all that much encouragement to just hold the line. The day of the report, the price went up 6.5%, and it has since pushed right back to being within cents of its all-time high, which I'm hoping it will punch through any day now. The total portfolio movement for the month looks relatively flat, but as far as flat goes, it was a hell of a ride, with Hum at one point being up over 60%, ORA at one point being up 20%, and both of them crashing way back down, pretty close to where they started. But even though I hate it when the orange line goes down, I shouldn't lose sight of the fact that this episode marks another new high for the portfolio's year-to-date return, bringing us to a 26%-ish gain so far. Honestly, if the year ended right here, I would be more than happy with this performance, but we have another 4 months, and hopefully in that time we can squeeze a little more performance out. Finally, I've decided that keeping a monthly schedule is dumb, for a bunch of reasons. Partly because dividend season fucks up the charts because my script can't track X dates, and partly because sometimes nothing interesting happens. So I've decided from now on, I'm essentially just going to make up the episode timings as I go. I will be aiming for 1 month apart when there's interesting goings-on to record, and stretching it out to 2 months apart in the event the portfolio has a boring spell. Thanks for watching, and I'll see you in the next video.